Yes. Yeah, can you tell us, please? Equity market. Equity and bonds. Exactly. And what was the last market? Derivatives. Perfect. Right. Okay. And there was also one more. Foreign exchange market. Right. And what was the challenge we had in the foreign exchange market?
Currency rate.
There are two prices in the foreign exchange market, and we can talk that. Okay, so that was the first type of market, financial market, divided according to the type of assets. Now we're going to talk about the financial markets evaluated according to the maturity of the financial assets. So, the second type of financial markets are evaluated according to the maturity of the financial assets. So, what do we mean by the maturity? Maturity is a time that the borrower has to pay back the loan, to pay back its debt, okay? So, in other words, the length of time that has to take, the length of time to pay back what is borrowed, okay? So, according to the maturity, the first type of markets are money markets, and the second type of markets are capital markets. Can everyone see at the back what I write on the board? Perfect. Okay, the second type is capital markets. Right. Okay, so there are two types of market according to maturity. First one is the money market, and second one is the capital market. Okay, so what is the difference between the money markets and the capital markets? Yes?
The money markets deal with like short-term debt. They deal with short-term, and capital markets deal with long-term.
Exactly. The maturity of the financial assets traded in the capital markets have a longer maturity, whereas the securities traded in the money markets have a shorter maturity. So there is a threshold between them. Do you know the threshold? How many years? How many months? 1 year, exactly. So if the financial markets have a maturity of less than 1 year, okay, they have to be paid back in less than 1 year, they are called as money market securities. Okay? Whereas, if the maturity of the financial assets is longer than 1 year, is equal to, let's say equal to, and longer than 1 year, they're called as capital market securities. Okay, so that's a clear distinction, isn't it? So that's how we diversify the financial markets according to the maturity of the financial assets. Right, so which financial assets are more liquid? The ones in the money market or the ones traded in the capital markets?
Money market.
Money market, exactly. So liquidity, we define liquidity as how easy can it be converted into cash and with the least cost. So money market securities, they are more liquid. Okay, which one is more risky? Money market securities or capital market securities?
Capital market.
Capital market, exactly. As the liquidity decreases, the risk increases as well. Also, think of the situation. You invested in a financial asset which has a long maturity, and think of all the parameters that can change. For example, interest rates may rise, inflation may rise, whereas the return on that financial asset will stay constant. Isn't it a risk? Isn't it a risk? Do you think it's a risk? Let me explain it better. Okay. First of all, let's clarify what is traded in the money markets and what is traded in the capital markets. So, can you give me an example of a financial asset traded in the money market?
Stock.
Yes? Corporate debts? Yes, it has to be very short-term. Commercial papers, for example, it has a maturity less than 1 year. Yes, it's a good example. It is a money market security, but there is a very popular money market security.
Stocks.
It's not stocks, yes? Treasury bills, exactly. Right. T-bills are very popular securities traded in the money markets. Okay, because the maturity of the treasury bills is less than 1 year. And basically what happens in the treasury bills is they have a maturity of 4 weeks, 12 weeks, 24 weeks, 42 weeks. What happens is there is a face value in treasury bills. We're going to talk about that probably in chapter 5, if I'm not wrong. Okay, the face value is what is going to be paid to you at the end of the maturity, but you buy it from a lower price today, and at the maturity, for example, it has a maturity of 24 weeks, 24 weeks later, you're going to be paid the face value, which is higher than the price you bought it. Okay? So, treasury bills are the debt securities issued by the governments. Okay? And they have a maturity less than 1 year. And most of them are exempt from federal and state tax. Is that correct? As far as I know. Okay. So, treasury bills and CDs, certificates of deposit, these are very popular money market securities because they have a maturity less than 1 year. Okay, so let's talk about the capital market securities. What are trading in the capital market? Stocks, exactly, because stocks, what is the maturity of a stock? There is no maturity. Well, unless the company disappears, because when the company disappears, you won't be an owner to anything, right? So stocks, they are capital market securities. And, tell me more. Bonds. Right. Treasury bonds or corporate bonds. Okay, they are debt securities issued by either corporations or government. Okay, and they have a maturity of longer than 1 year. Okay. Right. So, as we can see, let me repeat the question again. Which one is more risky? Capital markets. And think of the situation. And think of the interest you would earn from the bond. Let's say your rate of return from the treasury bond you have just invested in is something like 3%. Okay? And its maturity is on 2050. But think of the situation. If the interest rates are increasing and if they rise up to 5% in 2013, can you see that your return will be limited to 3%, although the interest rate a year later in the market is 5%? So this is called as the interest rate risk, but we'll talk about that in detail. Okay? The longer is the maturity of your investment, the higher is the risk you're prone to because of the increases in the interest rates and others as well. So as you can see, as the maturity becomes longer, the opportunity cost of your investment increases as well. Is that clear? Do you want me to repeat again? Yes, okay. So think of the situation. So today is January 2012, okay? So today you invested, so this is the rate and this is the time. Today you invested in this bond, and this bond has a rate of return of 3%, okay? So your money is going to increase by 3%. So basically the value of your money is going to be like this on January 2015. But think of the situation. If the interest rates in the market increases in 2030, okay, so the increase is going to be something like that. Can you see the opportunity cost of this investment now? So with this investment, your money is going to be something like, I'm going to calculate on my mind, 2030, but if you hadn't invested in that bond and kept it on it, your money would have increased in 2050. So this clear? Now? Do you want me to repeat again? No, great. Okay. So, the longer is your investment, okay, the higher is the risk that is involved with the money you tie to it. Okay, so basically this is the second part of the definition of the financial markets. Money markets and capital markets. So, stocks and bonds. They are the best examples of the securities traded in the capital markets. Right, so this was the distinction according to the maturity, right? And the third distinction is made according to the ownership. In other words, the owner of assets. Right, so what do I mean by that? Let me write down the names and I'm going to explain it later. So according to the owner of assets, financial markets are further divided into two groups. The first one is the primary market. And the second one is the secondary market. Does any one of you have an idea about why we have such a distinction as primary market and secondary market? Anyone have any idea? Yes?
I'm just going to make a wild guess.
Yes.
When stocks are issued, it is sold in the primary market. When they're resold, is it considered a secondary market?
That's correct. That's correct. So primary market is a market when the securities are first sold. Okay? So what happens in the primary market is the issuer of that security sells it to the investor for the first time. Okay? Whereas in secondary market, the investor who has previously bought that security doesn't have to hold it forever. He can sell it to other investors. Okay? So you can see that the exchange of ownership takes place in the secondary market. Okay? So already issued securities are resold to other investors in secondary markets. Okay? For example, stock exchanges are great examples of secondary markets. In stock exchanges, the equities which were previously issued by the firms are resold to other investors. So, when these equities are resold, the total number of these equities do not change, but the value changes. So if the investor thinks that these securities are overvalued, basically sells. Okay? So these already issued securities are resold. The ownership is exchanged in the secondary markets. Okay? For example, New York Stock Exchange is the best example for that. So could you understand the distinction between these two? Any question? So primary market and secondary. Yes, do you have a question?
Primary market, can you describe it?
Okay. In primary market, the primary market is where the issuer of the security and the first buyer of that security comes together. Okay? So primary market is a market where the securities are sold for the first time by their issuers. Okay? They're sold for the very first time. Whereas in secondary market, so the first buyer comes to the secondary market and resells these securities to the new investors. And this goes on and on and on. Is that clear now? Any other questions? Right. Okay, so the last distinction will be made according to the time scale. So what I mean by the time of sale is, how does the exchange of ownership take place? Okay, how are these financial markets bought and sold increases, we see the auction markets. Right. So let's see what they're all about. Right. In dealer market, basically this market is made up by the dealers, as the name suggests. Right. Do you know the definition of a dealer? What is dealer? Yes, you have an answer.
When you buy something at a certain price and then you sell it at a higher price.
Exactly, that's the correct answer. Okay, what dealer does is, dealers buy these financial assets from a lower price and sells them from a higher price. And the difference between the buying and selling price is basically is profit, is income. Okay? So in dealer markets, there are two prices. And we're going to talk about them in detail. So bond markets are like that. Okay? Have you heard about the bid price and ask price? Yes? So what is a bid price? What is an ask price? Sorry? If you want to sell something, this is the price for which you can sell, isn't it? As an investor. If you want to buy something, simultaneously, this is the price for which you can buy. Okay. So which price, basically the bid and ask price, is the same, is the price, is two different prices, I'm repeating it, sorry. Bid and ask prices are the two same prices for one financial asset. Sorry, it's a wrong. Bid and ask prices are two different prices for one financial asset. Okay? So think of the situation when you buy foreign currencies. I think we talked about that. Foreign currencies also have two prices at the same time. So what happens in the dealer market is, if you want to buy a financial asset, you basically buy it from, as an investor, for example, $120. For example, if you want to buy a bond. If you want to buy a bond, at that time, the price is going to be $120. But simultaneously, if you want to sell that bond in the dealer market, the price from which you can sell, is it going to be higher or lower? Lower. It's going to be something like, let's say, 110. Okay? So basically, this price is the price from which the dealer sells to you, and this is the price from which the dealer buys from you. And the difference is basically the spread. The difference, the other words for difference is spread. This spread is the dealer's income. Okay? So I will tell you why this takes place for some financial markets. Okay? So we see that as the volume of financial assets traded in the market decreases, we see that the prices occur as two different prices for the same asset. Did you understand that? Did you understand the dealer market? Any questions? Shall we move to auction markets? You have a question?
Yes, or could you re-explain the spread?
Okay, the spread is basically what happens is, for example, you want to buy a bond in a market, okay? If you want to buy this bond, you buy it as an investor from a higher price, so $120. But simultaneously, if you want to sell it, if you want to sell the same bond at the same time, at the same moment, you sell it from a lower price. Because basically you buy it from a dealer or you sell it to a dealer. Okay? Of course, a dealer buys these assets to his name and he sells that for a profit. So how does the dealer make money? The dealer makes money through basically selling them to the investors from a higher price and buying them from the investors from a lower price. Do you see the spread? So this spread is basically the dealer's income. The dealers do that job because of that. Any questions? Shall we move to the auction market? Okay. So the auction market, I auction, everyone gives a price, and that asset is sold to the person who provides the highest price. Is that correct?
Yes.
So that is the way how our auction works. Basically, stock exchanges are great examples to the auction markets. Now, let me show you how this auction takes place. To do that, I have to clear this side of the board. Is that all right for everyone? Good. Okay, now I'm going to show you how this auction takes place. Can everyone see this side clearly from every angle? Good. Okay, now I'm going to show you how a price of a stock is determined through the auction mechanism. To do that, we use one formula that determines the price of the stock. We're going to come back to this formula later on when we're going to talk about stock valuations. Okay, so according to this formula, the price of the stock is determined by the dividend which is paid a year later, divided by the required rate of return on that stock minus the growth rate of dividends. So let me write their names. The price of the stock, the dividend which is paid in a year, and the assumption of this model is the dividends are growing at a constant rate. Okay? So G is the growth rate of dividends, and it is constant because this is our assumption. Okay, I'm going to explain later why we're making such assumptions when we're valuing the stocks. And this is the required rate of return, or expected rate of return, from that stock. Now, we're going to explain everything through this equation, okay? So, dividend is known, growth rate is known, growth rate is known because it's constant, but what is not known is the required rate of return. And what basically determines the price of the stock is the required rate of return of investors from that stock. Okay? And the thing is, this required rate of return basically drives the auction mechanism and determines the price of the stock. And this required rate of return is unfortunately very subjective. And let me show you how this works. Let's suppose that there are three investors. Investor A, Investor B, Investor C. Okay? And each investor has different required rate of return. And basically that required rate of return depends on how much information an investor has about that stock. Okay? So investor A, for example, let's give a name to the firm, the corporation that issued that stock. Can you give a name to this firm?
Cisco.
Cisco. Oh, is it written C-I?
SCO.
Okay. So investor A. See, like me, he doesn't even know how the Cisco is written. Okay, he has no information about Cisco, which industry it is in. Okay, what type of future prospects it has. So the amount of information investor A has is very low. Okay, so therefore, because A's information is very low, okay, what will be the risk he will be taking through investing in the stock?
Higher.
It's going to be high. Okay. If the risk you take for making an investment, for investing in that stock, is high, how will be your required rate of return?
High.
It will be high, right? So, R is the required rate of return of each investor, P is the price. Right. Okay. So let's suppose that A has a required rate of return of 15%, because A has no information about Cisco. Okay, so he doesn't form up future prospects for Cisco. So he's taking a lot of risks if you want to invest in that stock. Therefore, to compensate for that risk, his required rate of return is going to be high. So let's suppose that I'm going to write these numbers from my head without a calculation. Okay. The growth rate is known, the dividend is known. The only thing that was not known was the required rate of return, and A's required rate of return is 15%. But before that, let me ask you one question. When the required rate of return increases, what happens to the price? Decreases, because it's the denominator, right? Okay. So, A's required rate of return is 15%. So, the price is going to be, let's say, $7. Okay? Right. Let's come to the investor B. Investor B relatively has more information about the stock, about Cisco, compared to A. So Cisco is in the IT industry, is that correct? Okay. So B knows that Cisco is in the IT industry, and well, he doesn't know when it was established, but he knows that IT has some moderately good investment prospects. So B has relatively higher information about Cisco than A. Okay. So when you compare the risk B is taking by investing in that stock in A, do you think B is taking more risk?
Less risk.
Less risk. So what will be his expected rate of return?
10%.
10%. Lower, okay? So the price is going to be, let's say,
6. 9.
6? Is it going to be higher or lower?
Oh, and higher. 10.
Higher. So it will be, let's say, $11, okay? So, shall we move to investor C? Okay, investor C has the highest level of information about Cisco compared to B and A. Okay, so when you rank them, do something like that. So the information level of C is highest compared to B and A. So C knows when the Cisco was established, what kind of alliances it made, what type of investments it made, the total number of employees, all the international transactions, and what type of future investments will take place for Cisco, knows all the opportunities and threats that Cisco is exposed to. Okay, so C is even like an insider to Cisco. And so because of that, how much will be his required rate of return?
5%.
5? Yeah, let's say 5%.
1%.
Because he has lower level of risk by investing in that stock, he will have a lower level of required rate of return to compensate for that risk. Okay? And how much will be his the price that he's ready to pay for it?
20.
Then
15 or 20?
15. Okay, let's see. Okay, now the auction is going to take place. But before that, did you understand everything going on in here? Do you want me to repeat anything? Yes?
How risk is involved in striking stock?
That's a good question. How risk is involved with determining the price of the stock? Okay. The risk is originated from the level of information that the investor has. Okay? For example, think of A. A doesn't know anything about Cisco. Well, is it an IT firm? Is it a manufacturing firm? Is it a tourism firm? He doesn't even know. So because of that, he has no idea about Cisco, and he doesn't know what type of return the Cisco can provide in the future. As you can see, Cisco is a very risky investment for A, because he has no information about it. So because of the high level of risk he's taking, okay, he will ask for a higher rate of return from that investment, because he has to be compensated for the high level of risk he's taking. Okay? Whereas when we look at C has a lot of information about Cisco. Basically, that investment is not very risky for him either. I mean, the future income, the future cash flows are more certain for Cisco compared to A and B. Therefore, he's taking less risk by making this investment, okay? And because of that, his required rate of return is going to be lower, and eventually, as you can see, the price each investor is ready to pay increases as the level of information that the investor has increases. Okay? Now, is everything all right? transaction starts, Cisco has issued a new equity, okay? Or Cisco's stock is paid, Cisco's stock is priced for $5. So in the market, Cisco's stock, a share of a stock is priced as $5. Now, as you can see, all these three investors are ready to buy the stock from $5. Is that correct? Because this is the price that they are willing to buy the stock from. Is that correct? Okay. Now, the auction continues and the price increases to $8. So what happens to A when the price increases to $8? Is he going to buy? No, he is going to withdraw from the market. He's not going to buy that because it's higher than the price he's willing to pay. Okay, the auction continues. Are there only two investors left? There's three investors. Is that correct? Okay. So what happens when the price of the Cisco stock increases to $12? B doesn't buy that. And who buys it? C buys it. Okay? So this is how the price of the stock is determined. This is a very simple matter. But I want to make a very important conclusion from that. Basically, who determines the final price for that stock?
Market.
Who? Which investor? C, isn't it? Because C is the one which has the highest level of information about that stock. Is that correct? There is a drawback in here, in this situation. What was the price that C was ready to pay for that stock? $15. And what is the price he bought it from? $12, as you can see. So, the conclusion is the investor which has the highest information determines the price in the auction markets, okay, in the stock exchanges. And usually that price is lower than what he is ready to pay for it. Okay? Does that make sense for all of you?
Yeah.
Okay. Now, this gap is very important. The reason is, the task of the financial market is allocating the capital. Is that correct? And the wealth of a nation depends on how accurate this allocation of capital takes place. Okay? So, the efficiency of this allocation also depends on how narrow is the gap between these two prices. Does that make sense? So, as the number of investors that participate in this auction mechanism increases, there will be a higher likelihood that there will be investors there will be a larger amount of investments, a larger number of investors with more information about the company, the stock. Okay? Therefore, the higher is the number of investors participating in this auction mechanism, participating into this financial market, the pricing will be established in a more accurate way. Okay? So this is the reason why we see some mergers in the world in stock exchanges. By merging, for example, especially in Europe, for example, Belgium, Netherlands, and Luxembourg, they merge into one. They merge their stock exchanges, therefore, they can provide a larger market with larger number of investors. Okay? So one of the reasons the US stock exchange, New York Stock Exchange, is one of the most efficient markets because the number of investors trading in the market, okay, buying and selling in the market is very high. Does that make sense? Does this reasoning make sense for all of you? Okay, so these are all about the financial markets. Do you have any questions? Yes?
So, the reason that
Excuse me, I can't hear the question.
so the reason why the gap is so important is because you want to, is it related to cash flow?
No, it's not related with the increase in cash flow. Okay, this is a good question. Please listen. Why is the importance of how large is this gap? country. So this is the waste of efficiency in the market. Is that correct? This is a waste of efficiency, waste of wealth in the economy. Does it make sense to you now? So if his stock was priced at $15, Cisco would be able to collect a higher number of funds, a higher amount of funds from the stock market. Yes?
So then it would be better for a company.
Sorry, the lesson is continuing. We haven't stopped yet. Please.
So it would be better for the company to have more money than the investor.
Sorry, it's better for a company to have?
So it's better for the company to have $15 rather than the investor have that extra $2.
Think about the situation. You issued 1,000 stocks, okay? You issued 1,000 stocks. This is the total number of shares you have issued. And the price of one share is $15. What will be the total amount of money you have created from this issuing?
15,000.
15,000. But think of the situation. A share of your stock is priced at $12, okay? So what will be the total number
12.
of money that you have collected?
12,000.
See? The difference, 3,000, is what you have lost because of the inefficiency in the market. Does it make sense now?